All right, let's talk about something we all think we know, our credit score. That three-digit number that kind of feels like it holds the keys to our entire financial life. But what if I told you that the score you're so carefully watching isn't the one lenders are actually looking at? What if your score has a secret identity? And that's really the big question we're tackling today. When you go to apply for a loan, is the credit score you see on your app the whole story? Well, the answer is way more complicated and honestly way more interesting than you probably think. So let's get on the same page. At its core, a credit score is supposed to be a simple summary of your credit report. It's basically a prediction of how likely you are to pay back money you borrow. Lenders use it to get a quick read on the risk. Sounds simple enough, right? Well, this is where things start to get a little wild. It turns out there's no such thing as one universal credit score. You don't just have a score, you actually have many of them. And that, my friends, is where all the confusion starts. You see, according to a major study by the Consumer Financial Protection Bureau, that's the CFPB, the score you get from a free monitoring service is usually what they call an educational score. It's designed to give you a general idea of your credit health, but it's often not the specific, heavy-duty score a bank is going to use for a big decision like a mortgage. So, does this difference really matter in the real world? Oh, you bet it does. The CFPB found that for about 1 out of every 5 people, the difference is big enough to drop them into a completely different credit risk category. We're talking the difference between getting approved or denied, or getting a fantastic interest rate versus a really, really expensive one. And check this out. This chart from that same report really paints the picture. Each one of those dots is a single person. If every score was the same, all those dots would make a perfect straight line. But look at it. It's a giant cloud. That means someone who's in the 50th percentile with one scoring model could easily be in the 70th or even the 30th with another. That is a massive swing. And here's the crucial thing to understand. This isn't a bug, it's a feature. This is what happens when you have a competitive market. You've got different companies, each creating their own scores, and each one has tons of different versions, all using a slightly different secret sauce to analyze your financial data. Now, for the last couple of decades, this whole market has basically been a two-horse race. You can think of it like the Coca-Cola and Pepsi of the credit world. You've got FICO and you've got VantageScore. FICO is the original. They've been the industry titan for decades, pretty much inventing the modern credit score way back in the 80s. But then, in 2006, the three big credit bureaus themselves, Equifax, Experian, and TransUnion, decided to team up and create their own competitor, VantageScore. And their recipes are definitely different. For instance, VantageScore is built to score people who are new to credit. It only needs 1 month of history compared to FICO's 6 months. And see how they handle inquiries when you're shopping for a loan? They treat that differently too. These little details can add up to very different scores for the exact same person. But at the end of the day, all these models are built on the same fundamental building blocks. If you look at the classic FICO recipe, you can see payment history is the absolute king, making up 35%. Right behind it is credit utilization. That's how much of your available credit you're using, at 30%. Just those two things alone make up almost 2/3 of your entire score. But things are changing. The way scores are calculated is evolving because lenders realize that just looking at a single moment in time might not tell the whole story. And that has led to something called the trended data revolution. Just think about it for a second. If I take one picture of you right now, does that photo tell me if you're getting healthier or less healthier over the last year? Of course not. And the same exact logic applies to your finances. This slide really breaks it down perfectly. An older score just sees a snapshot. It says, okay, your current balance is $500. But a score using trended data, that sees a short film. It sees that you've been consistently paying down your balance for the last 6 months straight. Now, which one of those stories do you think is more powerful to a lender? And this is exactly what the newest models like VantageScore 4.0 and FICO 10 are all about. They look back over the last 2 years of your credit history. They don't just see what you owe, they see the direction you're heading. They're measuring your financial momentum, which is an incredibly powerful way to predict what you'll do next. And look, this isn't just some interesting theory. This evolution is having a massive, real-world impact right now, especially when it comes to one of the biggest financial moves you can make, buying a house. So get this, in a truly game-changing move, the Federal Housing Finance Agency, the agency that oversees the mortgage giants Fannie Mae and Freddie Mac, has officially approved and mandated the use of VantageScore 4.0 for all the mortgages they buy. And you really can't overstate how big of a deal this is. For decades, FICO was pretty much the only game in town for mortgages that were sold to Fannie and Freddie, which back the vast majority of home loans in the US. That monopoly? It's officially over. So why does this matter so much? Because VantageScore's newer model can score around 33 million more people than the old models could. These are people who often have what's called a thin file, not because they have bad credit, but just because they don't have enough of a track record for the older systems to analyze. And the economic ripple effect is just mind-boggling. This single change is projected to open the door for up to an additional $1 trillion in high-quality mortgage lending. $1 trillion! This is about opening the door to homeownership for millions of qualified people who were basically invisible to the system before. So how does it do this? That being way smarter with data. For the first time on this huge scale, VantageScore 4.0 can actually look at alternative data, things like your history of paying your rent and your utility bills on time, to help prove you're a good risk. It's totally changing the definition of a qualified borrower. So after all that, what's the big takeaway? With all these different models and scores floating around, which is the number that you should be obsessed with? Here's the real secret. Stop chasing the number. Instead, focus on the behaviors. Every single one of these scoring models, it doesn't matter if it's FICO or VantageScore, old or new, is analyzing the exact same source document, your credit report. So focus on paying your bills on time, every time, and keeping your credit card balances low. That's the universal language that every single score understands. Because in the end, your credit score is just the headline. It's a summary of a much longer, more important story, the story of your daily financial habits. So the real question isn't just, what's my score? It's, what story is my behavior telling? Because that's the story every lender, using every model, is trying to read.